If you work in the telecom industry, you might want to pay attention here. Companies like Vodafone, Airtel, and Jio had to change their entire revenue recognition system since the introduction of the new revenue recognition standards Ind AS 115 and IFRS 15. How? Let's find out. Telecom is an industry where customer usually buys a handset with a prepayment plan. Under the new IFRS 15, the transaction price is allocated to the individual performance obligations in the contract and recognized when these obligations are delivered or fulfilled. Let's understand with the help of an interesting case study. For instance, Jio sells their unlimited 12-month international data and voice call plan and their handset to a certain Mr. Will at INR 1000 per month. Jio sells the same handset for 4000 rupees and the data voice call plan at a monthly charge of 800 rupees in the market. Under the new IFRS 15 and Ind AS 115, we must identify all the performance obligations first. In the contract between Jio and Mr. Will, there are two performance obligations. The first, obligation to deliver a handset, and the second, obligation to deliver data and voice call services for a year. The transaction price is 12,000 rupees. That is 1,000 rupees per month for a period of 12 months. Jio will now allocate this transaction price based on their relative standalone selling price. The performance obligation for handset and data services is 4,000 rupees and 9,600 rupees individually if sold in the market. The percentage for the same comes up to 29% and 71% respectively. Therefore, the allocated revenue of rupees 12,000 will be on the basis of 29% for the handset and 71% for data services, coming up to rupees 3,529 and 8,471. The big question here is, when will Jio recognize the revenue? Jio will recognize the revenue for handset when it is delivered to Mr. Will, and for the data and voice call services when those network services are provided on a monthly basis. That is, recognizing a revenue of 8,471 over a period of 12 months. How will Jio recognize the revenue for the handset and the data voice call plan that it sells to Mr. Will? Let's find out. What is the impact of this? The biggest impact is that all the telecom companies will now report profits differently. Even though the net profit for a particular contract will remain the same, the time of reporting might surpass one accounting period, resulting in a change in the bottom line of the profit and loss account and eventually the tax for the year. This, my friends, is called triangulation. To know more on how the new revenue recognition standard can impact your bottom line, attend our 3-hour breakthrough webinar. To register for the same, find the link in the description below. And for more such interesting content, subscribe to our channel Finance First now.